Hello everyone, happy Monday and welcome to a new video for Stockcharts.com on Monday the 29th of July. My name is Julius de Kempenaer and we're going to talk about sector rotation and the markets in general, of course. We kick off with a quick look at what happened last week and how maybe what we can expect for the week to come. I want to kick off with this weekly chart of the S&P 500. And this is a chart that I've been watching for quite some time because it is weekly. So it gives us slightly longer outlook, a little bit less noise. And just from a plain vanilla chart reading point of view, I like to use the RSI and the MACD. And what I've been observing here for the last few months is that the RSI has not been able to take out the previous high, building up a negative-ish divergence. For this one, I'm not too fond of it because we dipped below 50. And in general, I have kind of a rule of thumb that when the RSI drops below 50, you recycle, you start again. Nevertheless, it tells you something, but the MACD is pretty clear. This is a very clear divergence. We haven't dipped back below zero on the MACD. And you see that the MACD is crossing here. RSI has dropped back below 70. So this is something that at least gets me on the tip of my seat as a warning signal, as a bit of an outlook like, hey, something's cooking here. And when we bring that to the chart of SPY, then obviously you got a similar picture. So here, again, that negative-ish divergence and a real divergence in the MACD. We zoom in on the daily chart for SPY, that is, then I think the picture gets a little bit more clarity. We had that, this is a very clear negative divergence that was built up from July 10th until July 16 and then 70. I like to use the break below the previous low in the RSI as sort of a trigger execution of that divergence. And that happened here on the 17th when we had this first dip, and then we started the decline with the break of the channel on the 18th and then a couple of days of recovery, where the old support line started to act as resistance. So pretty much according to the technical expectations. Big gap down on the 21st, below the previous low. So this started or basically confirmed a new series of lower highs and lower lows. And then we dipped last week on the 25th, that was Thursday, exactly at the bottom of the gap. So this expected support range did exactly what it was expected to do, catch the decline. And then we got a bit of a recovery, and today, this is Monday the 29th, we're still in that, and you can see that we had quite a good opening, but we're already starting to decline again. So obviously we'll have to wait and see how that plays out the rest of the day. But what I'm looking at right now in terms of SPY is a pretty important support level, I would say, at last Thursday's low. That's 537.45, let's say, the 537.5 area. And then the upside, I think, is going to be capped pretty much around 550. So for now, it's a trading range, 550, 537.5. Given the series of lower highs and lower lows that is emerging or has emerged, I think the risk of a break lower is bigger than taking out overhead resistance. We're in, at least on this daily chart, in consolidation, setback, decline mode. So caution is definitely there. I've been telling you that for quite some time, and I think we're executing that. If we dip below 537.5, then we will have quite a few support levels to watch on the downside. And what I'm doing is pretty much looking at previous highs and lows. They're usually pretty reliable support areas. especially when they line up. You got a cluster of previous highs and lows. That's usually a pretty good support area. And I see that happening here. That's around 532. And I see it happening again here in the 524, let's say 525 area. This is where we peaked 3 times when we transitioned from 23 to 24. And then we broke it. And, this is a little dip here. But if my previous mentor said, if you use a very thick adding marker and you just draw a very big, thick line here, then you probably draw it somewhere like here, and all of that would be encompassed in your support area, your support zone. So that's the risk to the downside. Not super massive, but also not negligible. It's meaningful enough for someone who is looking to get into the market to get a better price, or a real short-term trader who might want to consider trying to play the market from the downside. When we take a quick look at the developments in the VIX index, then you can see a pretty big spike after months of very low readings for the VIX. And a rising VIX, as you know, is usually something that investors don't really like. Investors like clarity, like low volatility, and that is not the case anymore. You got the VIX rising, so we got a little bit more volatility. Pretty normal situation when the market is in consolidation or in a little decline. When we look at the dollar index, we go over like a high-level asset class type review, then you can see how the dollar index is still trading in a big triangle formation. We just bottomed out at the bottom and we started rising again. So the dollar is getting a little stronger, not necessarily a good sign for the stock market. And if you translate that to, let's take the daily chart, the weekly chart of euro dollar, then you can see how euro dollar is starting to move lower and still inside that triangle, probably gonna eye 107. We're currently around 109, high 108s. So a big figure, one handle in euro dollar, risk to the downside or potential if you're a dollar bull. If we take a look at the bond market on government bonds, then you see GOVT here, which is the aggregate ETF that covers all maturities on the yield curve. It's breaking out on the upside, which is positive in terms of price, and that means pushing yields down, which in general would mean a positive sign for the stock market, but it's not translating like that at the moment. And we see a similar move in IEF, that's the 7 to 10 year bond index, 7 to 10 year Treasury bond ETF. A pretty clear break to the upside, which signals lower rates ahead, or at least a pause in the rising rate environment. And I think that's an important element to take into account and take into the back of your head and into the equation, because when you bring that up to the stock bond comparison, and we can do that here when we do SPY versus IEF, take the ratio, and this chart is a very high correlation with the S&P 500. But here you see the preference for stocks over bonds when the trend moves up, and vice versa when the trend moves down. And there is a very clear break of trend. We break below the previous low in that ratio. And here the divergence is pretty clearly visible. And this is the chart of the S&P 500 for reference, by the way. And here also, as I explained to you, for me, the kind of a trigger to execute divergence is when the RSI dips below the previous low. And that has just happened here last week in combination with basically a break of double support, because we had the previous low and we had the rising support line. So all in all, I think that the message that this chart is sending us is that, at least for the time being, bonds are going to be preferred over stocks, or it's going to be balancing out. There's basically no preference, and that means when it's moving sideways. So we've got a wait a little bit longer before this trend starts to give us more insight into what it wants to do, because it's not yet a very clear series of lower highs and lower lows, but it's pretty clear that the uptrend is gone. So the rise is over, and we're now either moving into a sideways pattern or we've already started a move lower. And it doesn't matter what it's going to be, because the basic message is that stocks are at risk now versus bonds. At best, we're going to move sideways versus bonds, sideways in the market as well. And clearly we want to see how that plays out on a relative rotation graph on an RRG. And this is the default RRG that we have for the various asset classes. I have ticked off Bitcoin for now because of the big outlying move, going up, super strong move. And what you see here is that the dominance of SPY, so the real strength of SPY and the move further into the leading quadrant, has now rolled over. We are now moving at a negative heading for SPY, which means that it's moving lower on both scales. And you see the opposite happening for GOVT. So here is government bonds. They are starting to move. They're already moving to the right on the RS ratio scale, and they're now picking up on momentum again. So an early move on the weekly RRG favoring government bonds or bonds in general, because corporate bonds and high yield are also turning a more positive way. Here you see the dollar index still in a negative rotation, but it's starting to pick up. And real weak tails for commodities, really long weak tails. So they are basically out of favor at the moment. Now this all becomes much more clear when we change the weekly RRG to a daily. Then you see how this rotation has been playing out last week. And if we do that here on the fly, and again I need to tick off Bitcoin, look at how strong that move has been and still is. And you will see here how SPY has rotated or is still rotating out of favor at the cost of pretty much all government bond related ETFs. So there's corporate bonds, high yield, and government bonds. And if you look at how that played out over the last few weeks, then you can see the strength of SPY here was still rotating on the right hand side, and now all of a sudden it started to move towards and into the lagging quadrant, while the cluster of bond ETFs is moving into the leading quadrant. So this is a very clear near-term signal favoring bonds over stocks. And again, please be careful. This is all compared to VBINX as the benchmark. And that means that even when bonds would go down in price, but they go down less fast than VBINX and SPY, they will still end up into the leading quadrant. Just as a side note, but I'm pretty sure that all the regulars are very familiar with that concept of relative strength. And as we are approaching the end of the month of July, I'm going to take a quick look at seasonality. And here's the seasonality for SPY over the last 20 years. And you may notice that I'm ticking this bar one tick back. So that means that we're now getting all the figures here to completed 2023. If I would bring it up here, it would update all these bars, including the month of June. And I think that is distorting my image a little bit. So I'm going to do it here, and then next year I'll put it to a complete 2024, and I'll keep that for the entire 2025 year 2025. Pretty clear rally, first start of the month, start of the year, first few months, and pretty much an outlier month of July. Looks as if it has worked quite reasonably. It's going to be a challenge to watch whether July is actually going to be a positive month this year, and the average 2.4% gain is definitely going to be a challenge for this month. And what's up ahead of us is a pretty flat, at least from a seasonality point of view, period, with an expected return or an average return of 0.1, minus 0.6 in September, and then 1% up in October. So it's been all over the place over the last 20 years. Let's take a look at what that means or what that could mean for sectors. And I'm going to bring in my seasonality spreadsheet for this occasion. So these are the seasonal performances for SPY and then the sectors. And just as a recap, for SPY, it is actually the seasonality. So this is in absolute price terms. And for the sectors, it is relative versus SPY. So the number of months, the percentage of months that each sector actually outperformed SPY over the last 20 years. Again, updated until and including December 2023. And I'm playing this out during the entire year 2024. Now, we're starting August. So what we're looking at here is how am I going to call this? It has some outliers, but it also has quite a few sectors that are like very close to 50%. So the ones where, so SPY itself, 60% of the time showed a positive month in terms of price. And that is not a super reliable number. So, you know, toss of a coin is 50%, 60 is only marginally better. I am way more interested in the stuff where it's showing 75 or 80, or sometimes 30, 35, but in SPY that never happened. So 60% average performance for average up months for the S&P 500, and the expected return or the average return for the month of August is only 0.1% higher, which is also like, yeah, not really. If we look at the individual sectors, then there's a few that stand out. Materials is one of them in a negative way, because 35% of the time outperforming the S&P 500 means that the sector has been underperforming the S&P 500 65% of the time. So that's starting to get more interesting. Financials, 40%, real estate, 50%, discretionary, 45%. That's all pretty much like, you know, just in the middle of the road. Utilities, positive 60%. Again, similar, it's in the same boat as financials, 10 bips off the 50. Staples, smack bang in the middle, 50%. Healthcare, 60%. Then you got communication services, 44%. Not fantastic. You see energy also on a negative trajectory. So expected underperformance for the month of August. And technology is actually standing out with 70% of the time outperforming the S&P 500 in the month of August. Well, we're going to look at the chart and I can tell you already that that's going to be a challenge. And then industrials is at 40. So where we may have some opportunities is probably staples and energy from a negative point of view, and technology from a positive seasonality point of view. We're going to take a look. If we bring in the expected returns, so these are outperformances. So what that means here is materials in August minus 0.7. So on average, materials have been underperforming the S&P 500 70 basis points in the month of August. And with an average return of SPY of 0.1, that means that the average return for materials is down 60 basis points in the month of August. If we take that to the next one here, that is energy, 35%, so that's a low number, and the expected return, the average return is minus 1.5. That's a big number. Look at how big red that is. Same as the previous month, by the way. minus 1.5% below the S&P 500. And that means that the average return for the energy sector in August is minus 1.4%. And then we go to technology on the upside. So expected outperformance based on seasonal data. That means an expected return for the technology sector of 0.5%. 0.6 over August, so that's 0.7%. Am I doing this right? Yeah, 0.6, so 0.7% expected return for the technology sector in August. Let's take a look at the charts of materials, energy, and technology, whether we can either confirm or deny those seasonal rotations, or whether they are in play or not. Now, when we bring up the RRG for the sectors, and let's try to isolate those three sectors that I just mentioned. So here is materials, and that's interesting because from a seasonality point of view, this one is actually expected to underperform the S&P 500. But if you look at this tail, it has just started to pick up the pace versus the S&P 500. It's actually improving. And if you bring it up to, if I rank it here on performance, then over the last 5 weeks, the S&P returned 0.4, and materials actually pretty good with a return of 3.8%. Now, whether that rotation is gonna continue into August always remains the question, but this is a promising rotation. Nevertheless, it's inside the lagging quadrant, but it's let's put it like this: it's unlikely that this will all of a sudden, hook to the left and continue lower. And when we look at the energy sector, then we see kind of a similar rotation, also starting to curl back up over the last 2-3 weeks. It's lagging materials a little bit, but it's definitely improving over the last 2-3 weeks. And if we look at the performance, it's only 30 bips below the S&P 500 over the last 5 weeks, and it's rapidly picking up. So there is no alignment in terms of seasonality for materials and energy. So the historical seasonality, no, I need to put that different. The current rotation is not lining up with the historical seasonal tendencies for both materials and energy. Now, for technology, it's maybe even more non-aligned, because at the moment, technology is still the only sector inside the leading quadrant, but it's aggressively rolling over. It's already at a negative heading while inside the leading quadrant. And if you look at the performance over the last 5 weeks, technology is down 4.1% versus SPY of 0.4. And you can see, actually, it's quite a nice exercise. If you rank the sectors like this over the last 5 weeks, you can see that energy, communication services, and technology have been driving the market lower. All these other sectors, these are price performances in this column, have put in positive performances over the last 5 weeks, with real estate racking up 6.5% and financials 5.6%. And yet, with technology and communication services down 1.2 and minus 4.1, that's enough to keep the S&P 500 flat. This is the perfect explanation of how a broader participation in the market gives a market a good foundation. And what you see here is that the narrow foundation that was technology, and to a lesser degree communication services, they're now rolling over. So that's a big part of the market that's rolling over. And all the other stuff is moving up. So it's obviously not a zero-sum game in this respect here, but if you add up the market capitalization of all these sectors and compare that with the market capitalization of these three below, there's not much difference. you know, because both technology and communication services are quite large sectors. And here you basically only have consumer discretionary and to a degree healthcare that are bigger sectors. But they all have to be offset because this is what called in RRG lingo a closed universe. Anyway, the conclusion with regard to seasonality is that the current rotations are not aligning with seasonal tendencies as we have seen them. So that leaves us with very little or no trading opportunities from a seasonal perspective. It is what it is. Sometimes market throws you curveballs, and I think it kind of aligns with at least my general view of the market, where I think that we're, as I said in the beginning, we're at least moving sideways. Maybe we need a little bit more of a decline to digest the entire rally. I mean, the longer term trends are still unharmed, but within these longer term trends, you can get a decent decline without hurting those longer term trends. And again, if you're a longer term investor, you may get better opportunities to get back in or put more weight on your stock allocations. And if you're a shorter term investor, this may give you some opportunities to play the market from the downside. And as always, there are plenty of opportunities to trade on the long side for individual stocks, because that's one of the situations that we have right now, that it is now much more a market of stocks than a stock market. We're looking at the S&P 500 as the market, but if you look at the individual stocks, there's so much going on. So I encourage everybody to not only look at the S&P 500, maybe even not only look at the sectors on a sector level, but even go inside the sectors, because there are big differences, and there are stocks that are just breaking to new highs and doing really nice moves. It would be a waste not to play those, even with the market hitting the pause button. Like, probably the best way to say it. Obviously, RRGs will help you with that. You can just go into the drop-down box for the groups and bring up members of individual sectors. I wrote an article in my blog section on the site last week on financials, and I think that's one of the sectors that deserves our attention. So if you look at the financial sector versus the financials index, there are quite a few very interesting stocks to find there. And another thing that is interesting to see is if you compare the XLF universe to $1 and looking at absolute price trends, you can see how this sector is actually, they're all turning back up, and that means that these price trends are also improving. There are still quite a few on the left hand side, but you can see how the improvement is absolutely there for the financial stocks. And I've noticed that especially banks seem to be in very good shape. Anyway, going to leave it at this for this week. Thank you for watching, and as usual, put your thoughts, comments, ideas in the comment section of this video. I'll look at them, I read them, and I reply to them. And I hope to see you again next week, same time, same place.